What is the buy and hold strategy? The buy and hold strategy is a simple way of investing where you purchase shares, funds, or other assets and keep them for a long time, regardless of short-term market ups and downs. Instead of trying to predict when prices will rise or fall, you focus on owning investments that you believe will grow steadily over many years. Most people follow this strategy through index funds, exchange-traded funds, or large, established companies known as blue-chip shares. These can be bought through an investing platform or a retirement account, then left to grow over time. Why does it matter? Many people find investing stressful because markets are volatile and prices can move daily. The buy and hold strategy takes away the pressure of constantly watching prices or trying to time the market. It's based on the idea that, although prices may go up and down in the short term, markets and the stock prices of high-quality companies tend to rise over the long term as economies grow. Emotionally, it can be reassuring. You don't need to worry about every bit of market noise, which helps protect against mistakes like selling in panic during a downturn. Practically, it often reduces costs, since buying and selling frequently can lead to fees and taxes. By holding investments for years, you let compounding do the hard work, where your returns generate their own returns over time. This approach has also stood the test of time. Legendary investors such as Warren Buffett have recommended buy and hold for most people, noting that it consistently beats more complex trading strategies. Here's a simple example. Imagine you invest £1,000 into a broad stock market fund and simply leave it alone. The market might dip in some years, rise in others, and even face big crashes. But over 20 or 30 years, that £1,000 has the chance to grow significantly, especially if you add to it regularly. Now think about dividends, the payments some companies make to shareholders. If those dividends are reinvested back into your fund rather than taken out, they can snowball. For example, £1,000 growing at 7% per year could more than double in just over 10 years, and over 30 years it could grow to more than £7,000 without you adding anything extra. That's the power of compounding at work. What else should you know? Buy and hold isn't about ignoring your investments completely. It still helps to check in occasionally to make sure your portfolio matches your goals and risk tolerance. The strategy works best for long-term horizons such as retirement savings, where you don't need the money right away. If you might need your money in just a few years, this strategy may not be the best fit, since markets can fall sharply in the short term. One common misconception is that buy and hold means do nothing. In reality, it's about being patient and disciplined, not careless. It also doesn't guarantee profits. Markets can underperform for stretches of time, and you need to be comfortable with ups and downs along the way. Another key point is that the biggest risk for many investors isn't actually the market itself, but their own behavior. Panic selling during downturns or chasing the latest hot investment often leads to poor results. Buy and hold helps reduce these emotional mistakes by keeping you focused on the bigger picture. To sum it all up, the buy and hold strategy is about investing for the long run, ignoring short-term noise, and letting time and compounding work in your favor. It's simple, low cost, and has a long history of success, especially when used with index funds or retirement accounts. It doesn't remove all risk, and it isn't suitable if you need quick access to your money, but for long-term goals, it can be one of the most reliable ways to build wealth steadily over decades. Thanks for watching this video. Not sure where to go from here? You don't need another video, you need a plan. Grab the free 5-day series below and start investing with confidence. The link's right here on screen and in the description. Don't miss out.